very pleased to have Jonathan Trichter join us. Now, Jonathan, who I've gotten to know over the last year or so, is an investment professional. He is also an expert in public pension and public finance, and coincidentally also happens to be the Republican Party candidate for New York State Comptroller. I want to state up front, Jonathan's participation in this call is not in any way meant to mean an endorsement of his candidacy. Jonathan, I believe, or we believe, has some very relevant insights and experiences that he'd like to share with us, knowing that many in the audience are professional investors from the hedge fund space. So let me give you a little bit of Jonathan's background before I ask him to make some opening remarks. He is an investment banker, extensive experience in public pensions and public finance, as I noted. He has worked at J.P. Morgan, the restructuring firm Meva Group, LLC, and has served on underwriting teams for the largest municipal bond issuers in the country. His work has helped state and local governments identify major long-term liabilities that were previously unaccounted for. More recently, he has been active in New York State government, policy, and civic causes. Jonathan has spent the earlier part of his career with New York City government in various political campaigns. While at Meva, where he was a key leader on the largest out-of-court pension consent process and a corporate restructuring for private sector workouts, he later ran the municipal restructuring subsidiary at Meva, which was tapped by the Pew Charitable Trust to work on public pension restructurings across the country. In this capacity, Jonathan helped some of the most meaningful, or led rather, some of the most meaningful pension reforms implemented by cities and states at that time. In Jacksonville, where he worked for Mayor Alvin Brown and the police and fire unions to restructure one of the most distressed public pensions in the country, the work ultimately preserved the system's defined benefit status via a consensual solution that saved the city nearly $1 billion. Okay, so obviously he's got a great deal of experience. In a moment, I'm going to turn the mic over to Jonathan, but before we do that, I do want to thank our sponsors, without whose continued support this would not be possible. Those sponsors include Alston Bird, Baker Tilly, BNY Mellon, Bloomberg, Deloitte, Grant Thornton, Ferential Systems, New Mountain Capital, Benesch, and Kaya. So let's move into this. And here again, our title is The Challenges Alternative Investments Face Among Public Pension Funds. And this is a topic that we should, as investment professionals, all be familiar with, or at least hear different views on. So Jonathan, I'm going to turn this over to you now. I know you have a couple of slides to sort of set the stage. So let's go to slide 1.
All right, sounds good. Thank you very much, Bob. I want to thank the organization. I appreciate the opportunity to chat with everybody. As Bob said, my background is steeped in public finance as well as public pension management and workouts, municipal restructuring, and public pension investing, although I'm sure that on the investment side, I'm one of the least experienced people on this call. And also I want to point out that in my career in public pension restructuring, I happen to have played a marginal role in the restructuring of a Kentucky pension plan, which was featured recently on the PBS show Frontline, which ran a 1-hour documentary on the public pension crisis in America. For those of you who saw that, the pension workout we did in Kentucky was criticized by Frontline, as are a lot of pension workouts, because the optics are always terrible, of course. We come in and, we cut benefits. The benefits are usually unaffordable to begin with, and we're seen as the bad guys. We can talk about that challenge when it comes to restructuring public pensions. But it's a significant challenge when you think about the larger public pension crisis in America. And the first slide touches on that a little bit in terms of the aggregate unfunded pension liabilities in the U.S. from cities and states combined is likely around $5 trillion. Sometimes the number is quoted at $4 trillion, sometimes as high as $6 trillion. It's a significant number for all of those who can compare it or think to compare it immediately to the U.S. GDP. And if you combine the TARP bailouts, AIG, the S&Ls, and the auto bailouts, and any others you can think of, you still only get to $700 billion. So if many of the pension benefits are inviolate at the state and local level, and those whose benefits depend on that promise are going to depend on or hope for a bailout, you're looking at a bailout in size that couldn't help but precipitate a major financial incident, right? So it's often the case in the history of economics that in hindsight these financial crises are obvious, but up until they actually occur, they're not so obvious. In this case, you can kind of see it coming. And for those of you who are on the call and you're thinking to yourself, well, geez, how can I make money on this? First of all, don't feel bad because, you know, your thought is that you might want to make a few bucks on the pension crisis in America. It's occurred to me as well, but the short answer is, unfortunately, you can't short munis, and the answer is because there's not enough liquidity, and I can go into further detail on that, but it's occurred to me as well, and it's hard to make money on this. We just have to kind of look around the corner and hope for some kind of workout that minimizes the pain. So with that, the second slide is focused on the New York Pension Fund itself. I'm running for state controller in New York State, which is not unique, but it's one of a very few sole trustees of a large public pension fund. As I like to joke, it's got the market power of a Saudi prince, right? It's a $200 billion fund.
Well, what does that mean exactly, sole trustee?
Yeah, so most public pension funds have boards of advisors, and usually the boards of pension funds lack financial talent. You know, the theory is that, and the conventional wisdom is that with a board of directors overseeing a pension fund, you've got a diversity, some talent, checks and balances. But if you look at the corruptions, inefficiencies, and some of the crises in the public pension space, a lot of it happens where there are boards, so it doesn't seem to be a cure-all by any means. And then in New York and Connecticut and maybe one other place, you've got the sole trusteeship where there's just one person in charge of the pension fund who is responsible for setting actuarial practices, but also the investment approach and the actual investments. So there's really the ability, although the current controller likes to define his responsibilities down to being ministerial in many cases, the truth is that being the sole fiduciary of this pension fund really comes with unilateral authority to invest its assets as he sees fit. So it's about a $200 billion pension fund. The assets are allocated according to pretty much how most public pension funds assets are allocated across the country. A little bit more equitized here in the state. We got about 55% of the asset allocation in equities, another 20% in alternatives, which is a little lower than the aggregate in the rest of the state, but still, the country, excuse me, but still you're looking at about 75% of the fund being equitized, and that's about right in aggregate across the country. And if you're thinking, well, geez, that sounds like it's over-equitized for a fund that's supposed to be funding promises that are inviolate, the risk doesn't seem to match the actual the risk of the liability, which is certain, then you're right, and that's economic theory, and it's a big problem, and it's one of the reasons why there's a potential crisis, and that in the event of a downturn, the pain will be significant on funds that have taken on market risk to help try to basically invest their way out of the current underfunded levels.
So can I ask you a question here, Jonathan? So just looking at the trajectory here of the expected performance versus actual performance, what do we see here?
So this is one of the fundamental flaws of large defined benefit pension plans. You see it in the public space, but you also see it in the private sector space. For any of you investors who invest in companies that have MEPs, multi-employer pension plans, they probably have multi-employer pension plan problems, right? And the PBGC, which is supposed to serve as a backstop for MEPs, are underfunded. And any time you buy into a legacy company that's got a MEP, you've got a significant pension liability risk. So the problems with MEPs are similar to the problems in the public pension space in terms of how you calculate and account for your liabilities in the funded level of your fund. And most of it in the public pension space is based upon an expectation of achieving a rate of return in the future. And so if you expect a high rate of return in the public pension space, you can actually discount your own liabilities back at that same rate, which is a bit of a kabuki dance and isn't licit in the private sector. It can get you in trouble in the private sector, but in the public sector, for whatever reason, it's entirely licit. And so what you have here in this slide, what I'm showing is that since the current controller has taken office, he's expected, and basically he assumed a rate of return, a weighted rate of return of about 7.5% over his 11-year tenure. he only achieved about a 6% rate of return over his tenure, and the delta there is $65 billion, which means he undershot his expectations by $65 billion, and that amounts to pension debt. Now, there are 3 revenue streams that go into a public pension plan. One is the investment earnings. Another one are employee contributions, but in many states, including New York, those employee contributions are minimal. In some cases, they're at 0. And then, of course, there's also what's called employer contributions, which are the contributions that localities, counties, cities, and villages make on behalf of their employees, and they can be very onerous, and they fluctuate depending on how the investment assets do in each and every year. And so in New York State, $65 billion has been transferred down to the local tax level, and the comptroller has basically had to siphon up local tax dollars to make up for this underperformance next to his expectations. And so that's a big risk with large defined benefit plans in the public pension space. The investment shortfalls are backstopped by tax dollars. So I'm sure many of you investors are thinking, well, why am I in the private sector? Why don't I just go run a public pension fund where my shortfalls could be replenished pretty quickly by taxpayers? Yeah, it's a pretty good gig. So the second slide I have here on performance points to some of the challenges that alternatives are going to face and have faced over the past 10 or 11 years. This is a 10-year period. It happens to coincide with the period of the comptroller that I'm running against. And what I mean to show here is simply that the alternative portfolio has underperformed, specifically when it comes to the hedge fund portfolio of our pension fund and others around the country compared to the market itself. And this fund performance is obviously receiving more public scrutiny as people like Warren Buffett make highly publicized bets on 10-year returns of hedge funds versus passive indices in the S&P 500 and other indices. And it's receiving more scrutiny today just in the public sector, and there's public pressure, more public pressure coming on public pensions to isolate the returns of hedge funds, to incorporate more of the fees they charge in their returns and compare them to what they could earn without those fees. And some of that pressure is for the first time coming from new regulations which require better fee disclosures on behalf of public pension funds. So traditionally they have reported the 2% management fees, but not reported the traditional 20% carried interest fees. Obviously, very few investors pay the 20% on carried interest anymore, but just to shorthand it, they've rarely reported the carried interest fees, and new regulations on how they report each and every year, how they disclose their returns, are going to require them to do that. And as those fees become more transparent, there's going to be some more pressure on hedge funds to justify performance, and based upon the last 11 years, obviously that's going to prove challenging. The next slide here is basically just a comparison between hedge funds performance for the New York State Common Retirement Fund and what a passive index yielded in the S&P 500 and what that delta is. And you're seeing this again in New York State, but elsewhere across the country, more pressure on funds to justify investments in both hedge funds and other alternative assets, given what the market could earn over time with something that's a passive and virtually cost-free or a low cost. The funds in California, CalPERS has restricted hedge fund investments. I think they've banned them. And then NISLRS, the New York City public pension fund, has also banned hedge funds. And you're seeing more of that and a movement, political movement towards that. So my campaign actually calculated what the Common Retirement Fund or the New York State Pension Fund has paid in alternative asset fund fees since the comptroller has been in office. And it's a big number, right? And that's actually only through 2017. Last year, the comptroller and the fund paid another $850 million in fees to alternative funds. And so over time, 10 years, you're looking at a $7 billion a payment to alternative fees, and again, it's going to be hard to justify that as the fees become more transparent in disclosures if the performance isn't there. And so this next slide highlights an innovator in the public pension space from Illinois. Illinois's got one of the more troubled pension plans in the country, and the new either executive director or chief investment officer of Illinois is an evangelist for moving out of alternative investments and into passively investing the equity portfolio almost 100%, and bringing those investments in-house and limiting the amount of outsourcing to financial advisors and fund of funds, et cetera. The guy's name is Mark Levine, and he's published extensively on it, and he's becoming relatively well known in the space. He's a favorite of the Wall Street Journal and some other reporters, some other newspapers. This is Mark Levine actually writing on taking politics out of the system, picking winners and losers out of the system. And it's based upon the theory that if you are a large public pension fund, take New York State, if you're a $200 billion pension fund, you basically are the market, right? And it's going to be hard to find enough money managers who can actively beat the market when you've got that much capital to deploy to make it worthwhile. There are definitely money managers out there and funds out there that can beat the market for sure. But for a public pension fund, there's so much pressure to diversify that there aren't enough of those to justify large slugs when you take into account fees. And this is what Mark Levine is preaching. So one of the common refrains from hedge funds, especially when they look at and discuss their overall performance over the last 10 years, is that in times of market downturns, obviously hedge funds could do better than broader markets. And this is true, but for a place like New York State, and this may not be the case, you know, except in places like Illinois, New York State, and in California, but certainly for places like New York State, there's enough talent in the investment community that you could bring in-house enough investors and managers, money managers, to hedge oneself or in-house rather than outsource it to hedge funds. So here we're just talking about buying puts on the S&P 500 and the NASDAQ and other indices, as well as potentially purchasing assets that have traditionally provided a hedge against market downturns like gold, and then looking for other indices, newer indices like the iShares U.S. Real Estate ETF, which tracks the Dow Jones Real Estate Index, and buying puts on that. Now, this is, I mean, hard to do when you're a $200 billion fund, but not impossible. You have to syndicate it out, and obviously there'd be counterparty risk, but it's doable. And if you've got a fund in New York State that's got a sole trusteeship, it's actually probably doable pretty quickly if you get the right guys and gals in-house to do it. Now, it's probably going to be a clunkier process for those pension funds that have boards, and the talent is, you know, there's a bit of talent entropy, and it's going to be hard to get everybody on board because of, you know, because it's new, and there's always safety in what's in the past and tradition. But nevertheless, it could be the way of the future, and consider it something to look for. In addition, I mentioned that there's political pressure in a number of investment strategies for large public pension funds. There's also political pressure when it comes to various industries, right? When you're looking at public pension funds, they're largely run by political candidates, local political candidates, or local political appointees who are either elected by constituencies that include public sector labor and other liberal constituencies, especially in blue states, or were appointed by politicians who are somewhat beholden to public sector labor due to their outsized power in local elections. And a lot of those constituencies are very politically motivated when it comes to things like greenhouse gas and global warming and gun manufacturing and the fast food industry. And you're seeing more and more a level of political activism among public pension funds where they'd like to stay away from controversial industries that attract media attention and press. And this is a risk for alternatives because the opacity of private equity funds and hedge funds makes it harder for them to realize what companies they're in. So in New York State, in 2012, after Sandy Hook, our controller put out a press release touting that he would divest from all companies whose major source of revenue was derived from weapons manufacturing. And what he didn't disclose, or what he may not have even known, is that he nevertheless had a pretty sizable investment in Cerberus Capital Management, which is a $48 billion private equity fund, which at the time owned Remington, which was the gun manufacturer that made the AR-15 that was used in Sandy Hook. And so those risks, as politics plays more of a role in public pension investing, as the public and the Democratic Party gets, and the sort of progressive movement within the Democratic Party gets smarter about this stuff, those risks pose a risk to, those politics pose a risk to alternatives. Similarly, just the very anti-capitalistic rhetoric from some of our nation's most high-profile politicians. I'm not going to name names, but one of them, his initials are Bernie Sanders. Another one's initials are Elizabeth Warren. And, again, no names. But look, these people have vilified investors in distressed debt by using the derogatory name vulture capitalists, and some of us may use that name in a less derogatory way, but when they say it, believe me, they spit it out in a way that sounds worse than when we talk about it over coffee among ourselves. And just the very economic model of vulture capitalists are going to make it risky and controversial for public pension funds to invest in those kinds of alternative funds. We all know vulture capitalists can serve a very important purpose, especially if when they buy companies that are in distress, they help engineer success stories in restructuring. I have a background in restructuring, both in the private sector and public sector space, and I've interacted with some very responsible vulture capitalists. But, you know, at the same time, when you look at Puerto Rico and the status of Puerto Rico financially and its financial position, I would argue that the last people to blame in that catastrophe are the vulture capitalists who were the last lenders, or lenders of last resort after Puerto Rico got locked out of the tax-exempt markets. And the first people to blame were the leaders of Puerto Rico. Nevertheless, when you talk about culprits in the political space, it's always the venture capitalists that get singled out and blamed for Puerto Rico unfairly. So the challenges for alternatives, again, you've got the last, or for hedge funds, you've got the last 11 years to contend with. Obviously, private equity's had a better run, although they'll have their challenges as well, justifying how they can repeat the performance over the past 10, 11 years in the current interest rate environment. And with so much money flowing into private equity and so much deal, and only so much deal flow, right? I mean, just the undervalued companies, inefficient companies have been picked over for the last 10 or 11 years. So that's one challenge. The fee structure is becoming more public to those who pay attention to public sector pensions because of new rules that require more transparency there. The possibility of insourcing a lot of investments is a challenge, and then the ability to hedge, and then of course political hedging out, and then the political activists are going to pose a risk when it comes to industries like oil and gas, gun manufacturing, fast food industries, and most recently, you might not know this, but most recently, tech and social media. A lot of the more liberal pension funds, including my opponent, has written warning letters to the heads of Alphabet and Facebook for promoting hate speech that, if tolerated, might pose a risk to the bottom line and their holdings.
So, Jonathan, we've covered a lot of territory. I should say you've covered a lot of territory here, and I'd just like to stay on your last point and talk a little bit about alternative investments, hedge funds in particular. What is it you think they might be able to do to make themselves more relevant in the future? I mean, you talked about fees, you talked about relative performance, or underperformance, I think you said. You mentioned there's a series of large pension funds that have altogether eliminated alternatives from their palette of potential investments. So what is it you think alternatives, again, hedge funds in particular, might be able to do to remedy their situation as you see it?
Yeah, so I do believe the wallet is likely shrinking. But it's still the case that, let me think, pension funds are the largest investors in alternative assets and responsible for, I think, 33% of capital among the 100 largest alternative asset managers. And and the reason for that, as many of you may know, is the somewhat perverse incentives that public pensions have to chase risk, right? If they chase risk, they could increase their assumed rate of return in the future, which allows them to discount their liabilities back at a higher rate and pretend that they're more funded than they are. And that incentive structure compels them to look for yield. So hedge funds are always going to have that advantage when selling to public pension funds and looking for mandates, right? They could potentially promise outside yields, especially bear market. Nevertheless, the track record of hedge funds over the last 10 years being what they are, I think they're going to have to make the case individually that they are among the few money managers that can consistently beat the market with a strategy that makes sense, and also potentially open up via transparency what investments they're in, to be socially aware and conscious that their investors may have some optic problems when it comes to the retirees and the members themselves. So those are conversations those are items that might be worth addressing in pitches and discussing with potential clients. But I think there are some real headwinds.
So I'm trying to find the slide here. I think you said that New York State, and I don't want to pick on New York State, but I think this is a fascinating little factoid. $6 billion in fees. That's a lot of money.
Yeah, and it's over 10 years, but last year was about $850 million. About $200 million of that was hedge funds. And it wasn't known. Up until a few years ago, you couldn't really determine the amount of fees that large funds were paying to hedge funds. It wasn't reported, wasn't well understood. But the country is slowly getting more savvy about investing in finance. And GASB, which is the accounting regime that governs large public pension funds, has been very slow, but they're molasses, but they're not, totally static. And so their new reforms, I think it's GASB 67, Rule 67 and 68, require a bit more disclosure, even among private equity funds, which have traditionally been the least transparent in reporting carried interest fees. Sometimes they're just baked into the actual return themselves. But those those private equity carried interest fees may also be reported more. So it's something that hedge funds will have to contend with head-on and justify. I think there are still clients and funds out there that are willing to pay a premium to hedge, and I don't think that the talent is going to be there to bring it all in-house, to bring hedging all in-house, except in places like New York and California, Illinois. And even in California and New York, there are significant challenges to that, because I don't think my opponent, who may remain the controller after November 6th, has any interest in bringing a hedge strategy in-house and hedging via puts on various indices and other asset hedges. I don't think he's got the interest in it, the talent, the understanding of it, and so I don't think he'll do it. Illinois, I think they do have the ability to do that, and I think they are moving that in direction. And California, I don't think they've got the board makeup that would allow them to move in that direction aggressively, so I still think there's plenty of opportunity there.
So are you suggesting that given the size of some of these pension funds, it makes sense for them to consider insourcing really a lot of these investment functions?
Yeah. Look, if you can pay first of all, on indexing, if you can pay 6 or 8 basis points and index your equity portfolio, and if they do these studies in-house, they will see that on the equity side they would have done better over the past 10 years, on 5 years, having just taken the equity portfolio and investing in the S&P 500 and other indices. And then on the hedge side, again, this is, at the vanguard of where public hedge funds are looking, but it's around the corner, and people like Mark Levine are looking at it. And there may be benefits and advantages to helping them do that from large banks, if not hedge funds themselves. So, for instance, Goldman Sachs sold a product to the New York State Pension Fund, which created their own bespoke index. I think Goldman charged them, according to the controller, $1 million a year for it. But you can potentially create products that would allow these funds to hedge or index themselves via their own products. So if they wanted to design something that was socially conscious, I'm sure Goldman would be happy to furnish that for large public pension funds, and that would be a small step towards insourcing, which may open the door to more insourcing. So you may see more of that.
So just to stay on this topic of fees for a minute, I'm just curious. I think you said that the fund has approximately $230 billion in assets under management, something like that?
Well, about $200 billion, probably less this week than last week, but yeah.
Okay, and how much of that is allocated to alternatives?
Yeah, so 20%. The controller tried to increase his alternative asset allocation at one point, but didn't get that passed legislatively. And I think on average, the aggregate amount of investments in alternatives in the country is about 26%, so let's call it 25%. The last thing to say about that is public pension reporting and disclosures remain so opaque. Public states and municipalities and public pension funds don't like you looking in their dirty underwear. And so oftentimes what they classify as an alternative isn't the full story, right? A lot of funds may just decide that they're going to put opportunistic funds outside the category of alternatives because they want to make their asset allocation look more conservative, and they could do that. They have a board. If the board votes that they can do that, they can, and it's often hard to suss out. So the numbers are hard to compare apples to apples across the board from fund to fund, but these things kind of normalize. So you figure about 25% of public pension funds are invested in the assets are invested in alternatives.
Okay, and I remember seeing that op-ed piece. The gentleman that runs Illinois Pension Fund, Mark Levine. I remember reading that, I guess it's almost 2 years ago, and thinking to myself that relying heavily on index products could be problematic at times. I mean, I think when he wrote that op-ed piece, the market just kept on drifting upward and upward. So as we enter more volatile stretches, you will need to hedge. And again, could you just talk a little bit about the approach to hedging that would be appropriate with indexing?
Yeah, so this is where I mentioned that there are more savvy investment professionals on this call than I. I've been in investment banking. I've thought hard in theory and strategically about asset allocations and how large public pension funds should invest to match their risk to their liabilities more equitably. And I've thought hard about reducing fees. But if you want to drill deeply down into how a $200 billion pension fund could in-house hedge via puts way out of the money puts more cheaply, then you're probably going to escape my zone of expertise. I will say that I've worked for a number of high-quality investors who are better at this than I am, and I think it's possible, according to them. Again, it would take a high level of talent, and you'd have to be able to attract that talent in the public sector space, which means either convincing them that it is a public service to take a flyer for a year and a half or a year or 2 years to do it, or you'd have to be able to pay them a market rate. And, of course, the optics of paying anybody in the public sector more than $180,000 a year are terrible politically. And so, I think the real challenge, and you can feel free to correct me if I'm wrong, Bob, because, again, I'm not the smartest guy in the call about this particular issue, but I think the real challenge and the real bottleneck is getting the talent at the large public pension funds to do that.
I mean, don't universities have the same challenge?
My understanding is that I don't actually cover university endowments, but my understanding is that high-performing endowments pay above market rate salaries and performance bonuses, and you don't see that structure in the public sector space yet, except in places other than America. Obviously, in Canada, you've seen some funds run like that, but it does make sense, right? Pay for performance is a payment structure that I believe in coming out of investment banking. I think it works, and I believe in bonuses for high performance, but that is not a model that has ever worked in the public sector space because the optics are so terrible politically. Nobody, to get a success fee in the public sector space for anything, let alone investing, but let's say some kind of, even a contract, a sanitation contract or a capital improvement contract, success fees are almost non-existent in the public sector space.
So let me understand that. So if we project out 7% returns, but we only achieve 6 over the long run, we've got a widening gap.
Yes, this is the problem. This is why on aggregate pension funds in the country are only 70% funded. So we've got 70 cents for every dollar we owe in retiree commitments countrywide, and that's where you get that $5 trillion figure. But interestingly, if you want to talk a little bit more about the pension crisis, 70 cents is probably high, right? 70 cents is based on an aggregate assumption for rate of returns in America for public pension funds. And most public pension funds assume somewhere between 7 and 8%. And I think the average, if you average everything, it's about 7.6%. So public pension funds are oftentimes called dumb money. I don't call them dumb money. That's not true. I do call them dumb money. And 7.6% is aggressive. If you look at this, environment and an economy that's already gone through its evolution from being an agrarian economy through the Industrial Revolution to an advanced service economy. That kind of yield is going to be hard to find in an environment with inflation at around 2%, GDP growth sometimes at a sluggish 2%, although better, and then dividend yields at about 2%, right? So,
but historically, it's very difficult to achieve 7% year-over-year growth, is it not?
Yeah. So, and this is where public unions try to pretend that that's not the case, because they'll go back to a period of time, 30 years or so, again, when we were transforming from an industrial economy into the service economy, but experienced two bubbles, right? The tech sector and then the housing bubble. And if you look at some of the bounce backs from recessions over a 30-year period, you see periods of extreme growth, extreme market growth. And that doesn't seem likely in the future. If you talk to the greatest investors and the investment minds that the country has, again, Warren Buffett likes to point out that you'd be lucky in the equities markets to expect 6% going forward, and that looking in the rearview mirror is kind of foolhardy. And of course, even though I mentioned that public pension funds are over-equitized, they still have 25% of their assets either in fixed income or under the mattress. So earning more than 6% for public pension funds go forward is going to be impossible, and yet they're expecting an aggregate 7.6%. So whatever they earn, and then the 7.6% they expect, all of that is going to translate into additional debt. So that $5 trillion figure is going to climb, the burden is going to climb, and this has to end in tears.
So I just want to go back to something you said earlier, Jonathan. You said that on one hand, it's not we don't see public pension funds hiring or paying market rates or anything close to market rates on one hand, because it's just not politically expedient to do that, right? On the other hand, it's perfectly acceptable to run these performance gaps, knowing full well that the state has the power to tax. So any deficit, okay, between revenue and liability can be made up very easily through taxing.
Yeah, there's no incentive to perform. That's exactly one of the problems, right? When you've got a short backstop in the form of a large tax base and the ability to tax your way out of underperformance, there's no pressure to perform.
And I think you did say that they've begun, I guess Canada is out in front here, and I think it's Ontario Teachers. And Ontario Teachers is first of all, Ontario is not known, or at least not, my sense is that Ontario is not viewed to be a hotbed of conservatism. So it's interesting that Ontario Teachers, Ontario, the province of Ontario, would have taken this or made this bold move into a more of a performance-driven.
Yeah, it's kind of counterintuitive, I think, is the point you're making, right,
yeah,
Bob?
Yes.
Yeah, so I don't have a great answer there, except I do have a suspicion, a deep suspicion, that public sector labor in America is just very different than public sector labor in Canada, and that the two cultures are different, the histories are different, so that for whatever reason they are more nimble, more aggressive, and so have been much more creative and intrepid in terms of how they have run their own public pension funds.
Okay. And let me ask you one other question. We had a guest recently who talked about the application of machine learning and quantitative methods in investing, and it strikes me that one of the reasons that people like you and others think that hedge funds may not be the solution for pension funds has to do with the size, right? It's overwhelmed. It's just, how do you diversify? How do you pick so many managers, right? So my question is, do you see a role, I take it you would insource a lot of these functions, right, if you were successful at the ballot box. And I'm just curious, do you have a view in terms of how we might be able to apply this technology to the investment process going forward?
You know, I think there's a business there. You're way ahead of me and you're way ahead of the market on this, but I did joke around with some fellow public pension investors and experts in this space about what you could do if you actually did win over enough pension funds to invest passively, could you create basically a one-stop shop or a product that charges a flat fee and helps syndicate and diversify passively for pension funds in-house? I think there might be a business there. I don't know if it's 5 years away or 10 years away. You know, again, this is dumb money. They take time to kind of catch up to stuff. But for places where they don't have the talent to do this in-house themselves or hire themselves, there might be a business in acting as a consultant to help them do that in-house and automate a lot of it. And I have definitely thought about that and talked about it. But here's the other challenge, right? You've got largely public sector unions who serve on the boards of these billion-dollar pension funds and like it, right? The trappings of being on the board of a billion-dollar pension fund is kind of sexy, and for most people who come out of the labor movement, the opportunity to do that in the private sector just isn't there. So to passively invest their equity portfolio is to take them out of the game of choosing winners and losers and getting romanced and pitched by some very smart funds and individuals. And that appeal, that power is going to be hard for them to just to give up. And so if you're going to be selling an automated product to a board that likes to basically behave like a board, you're going to have to convince them that they need to retire. And so there's another challenge.
Well, I'll tell you, Jonathan, I just want to put someone on your radar screen. I want to give a plug to one of our previous guests from Matai Zatrino of SSTM2. Okay, I'll give you the information, but he made a very compelling presentation last month on this topic, and I would direct you to him. But in any event, I think that you're raising a lot of very important concerns here. Just out of curiosity, what do you think of hedge funds in general? Do you think hedge funds are more appropriate for running smaller pools of capital?
Yeah, so that's a good question. You know, obviously this presentation is a bit bearish on hedge funds, but I come from investment banking, and I think like all of you, I know plenty of slackers in the space and bad actors, but plenty of very talented investors who have made a lot of money and made their investors a lot of money as well. And so, you know, I'm pretty practical when it comes to the space and viewing them on the merits and calling balls and strikes. And obviously the place where you can see the most growth and potentially outsized yield is on smaller emerging funds that are nimbler and could put don't have to put as much capital to work and can pick its spots and find some advantages and opportunities. But again, the problems with a large public pension fund is that they need to put a lot of capital to work, and investing in small funds and doing the diligence on a bunch of small funds is going to be a bottleneck for them.
Terrific, terrific. This has been very interesting, Jonathan. How much time do we have? We've got a couple more minutes. But I want to ask you something. And maybe you're not comfortable answering this. Just out of curiosity, how do you see the House turning out?
Oh, so we're talking politics. First of all, it's a challenging year for Republicans. There have been some recent polls on just the blank ballot that show Republicans gaining some ground. But any off-year election where the president of the other party is in control of the executive branch is going to be challenging for the incumbent party. So I think the Republicans have their hands full. They've evened up the money gap in the closing days. They're going to have as much cash on hand, if not more, than Democrats in competitive races. But I think the Republicans are going to struggle to hold on to their majority. I was actually with the speaker at an intimate event with Hank Greenberg a couple of weeks ago, Mr. Greenberg, and you know, he was somewhat optimistic that they can hold on to the House, but also I think realistic that they've got a tough election cycle and some headwinds of their own.
Very nice. So, Jonathan, on that note, I want to thank you. We've received some questions from the audience. We've answered them. I want to ask you, do you have any closing thoughts that you'd like to share and make?
Yeah, sure. So I think that rather than speak more about your industry and what challenges lay ahead for you, I'll close by just discussing a little bit, again, the fundamental flaws with large defined benefit public pension plans and why this crisis is going to be so hard to correct course for. The incentives that I mentioned, the perverse incentives which require these pension funds to chase risk, aren't ending anytime soon, and they are absolutely part of the papering over of the true magnitude of pension liabilities in this country, right? Again, the whole structure of being able to assume one will earn a particular rate of return over time and one's ability to then discount one's liabilities at that assumed rate is just asinine. Nobody would ever start out, if anybody knew what they were doing with such a system. And the only place where you see this is in the public pension space, and it's coming home to roost. The problems that multi-employer pension plans have are similar but somewhat different in that regard, right? They've got the last man standing problem. They've got the fact that they're legacy companies and industries that have experienced significant decline and concentrations, mergers and acquisitions where those liabilities have been basically added on to smaller and smaller companies and employee and employer bases. And that's not happening in the public pension space. What's happened is that our financial structure, the way of accounting for our liabilities in the public pension space, we're so poorly thought out and now exercised that it's a function of poor accounting, pure and simple, and then the ability to cover up, what is a looming crisis.
You told me something recently that I found very interesting. The number of employees in the New York State Comptroller's Office is?
Yeah, so the Comptroller's Office is one of the more powerful Comptroller's offices in the country. I like to say that if I won, I'd be the most famous Comptroller in America, which is exactly the level of anonymity I'm looking for in my life. But it's got tremendous resources. This is why I think the Comptroller absolutely has the ability to bring a lot of this stuff in-house. The Comptroller's Office in New York State is over 2,600 employees, and its operational budget is over $346 million a year. And it's not just an investment arm. It's not just an investment fund. Our Comptroller actually is responsible for many other functions. But nevertheless, with 2,600 employees, you can absolutely fire a bunch and hire a bunch that have investment talent. And I don't think there's anything absolutely preventing a Comptroller to figuring out a fee structure that is higher than the civil service fee structure that most government employees have to abide by in New York State. I think there are ways around it. So I do think you can come up with some fee structures that, while not large enough to attract top talent in the investment community, nevertheless could tide certain talented investors over.
Let me just challenge you on that. Why shouldn't we have the best talent running the money? Why shouldn't we have the best people running state government? Why shouldn't the governor of a state of nearly 20 million people, why shouldn't the Comptroller make some money?
I think we should. I think we should. It's not a challenge. I think we're in probably very little daylight between us. The one caveat I would say, Bob, is that I think it only makes sense to pay for performance when you can measure performance. So how do you measure the performance of a governor, right? So a lot of times a governor's performance is measured on the number of bills they pass, but the bills are terrible. They obstruct business. They regulate. They're bad for the economy.
Well, we'll say you, right? I mean, right? Everyone has a different view of this, right?
But for a fund, actually, I was leading up to the point precisely, which is for a fund, you've got a very clear set of metrics, and so
agreed.
There doesn't seem to be an economic reason not to pay for performance. And as I said, coming from the investment banking world, I believe in a bonus structure and paying for talent. So I think we're in agreement.
Excellent. Jonathan Trichter, candidate for New York State Comptroller, I want to thank you for your time, for your insights. This has been a very interesting, I guess we've had about 55 minutes. I want to thank everyone for tuning in. And until we meet again next month, we'll be signing off now. And everyone have a great month. And Jonathan, thanks again. And I guess I'll ask you one last question. If folks want to reach you, I'm just going to go back to your opening slide here. So we have your contact information.
Yeah, they can reach me through my website, Trichter for New York. It's TRICHTER FORNEWYRK.com. and the email and contact numbers there all work. I'm happy to chat anytime. We'll be here through next Tuesday, and then after that I'm going on vacation, win, lose, or draw.
All right. Jonathan, thanks so much, and everyone have a great month. Bye-bye.